Good morning, students. Welcome to online classes. Dear students, in today's class, we are going to discuss very important topic, that is unit number 3, cost of capital. Before going to discuss a cost of capital, we have to overview what we discussed in the previous class. So, in the previous class, we studied the complete of different types of problems on leverages. And basically, capital structure and leverage is also very important topic relating to the case study, and also very easy to understanding the entire the concept of capital structure and leverages. Um, whatever whatever I had given problems on leverages as well as capital structure, keep it practicing it, and you will be understood the concept of leverage and capital structure. So once the online offline class is going on, in detail I will be discuss different types of problems on capital structure as well as leverages. And let us start in today class. What is capital structure? Sorry, what is cost of capital and the types of cost of capital. Let's start introduction. So basically in this chapter, two concept is there, cost and capital. See, cost means the amount spent on production of goods and services. It means whenever we are going to production of goods or services, at the time what we spent, that is nothing but a cost. It may be in the form of money, in the form of material, or in the form of labor. Next, capital is an important factors of production. Yes, of course, whenever we are going to moving to the production factor, the capital is playing very important role, because without capital we cannot do anything. So capital is playing very important role in the factors of production. Next, capital has a cost. Of course, capital is nothing but a cost, because on that capital we are going to paying interest. So when you are going to paying interest towards the capital is nothing but a cost is nothing but a one type of expenses. When we are going to taking the capital from the investors, so for that investors we have to pay it proper interest. So that's why capital has a cost, because interest is to paid on capital. Next, capital invested on both. Yes, whatever we are collected capital, so that capital we are invested in both the term. One is fixed assets, another one is current assets. Capital, sorry, cost of capital is one of the basic concern stolen of the theory of financial management. See, cost of capital is one of the basic stone for the financial management concept. To deciding the capital structure of a company, it is very essential to consider the cost of each source of capital. See, dear students, is most important. Whenever we are going to concluding the capital structure of any company, at the moment the cost of capital is very important, because the cost of capital is going to define the each source of capital is to be described by cost of capital. Let us move to the meaning of cost of capital. It is rate of return expected by the investors. Then what is cost of capital? See, cost of capital is a rate of return invested by the investors or expected by the investors. So it is a rate of return expected by the investors. So it's nothing but K means cost of debt, RO means cost of capital including the rate at zero risk. The rate at R means rate at zero risk. B means premium for business risk, and F means premium of financial risk. Next, one more meaning. It is a minimum rate of return the firm earns and it invested in order to satisfy the expectations of investors who provide fund to the business. Very interesting meaning. See, cost of capital, it is a minimum rate of return from, sorry, it is a minimum rate of return the firm earns as it is to investment. It means whatever, I will clarify in detail. See, whatever investors invested amount in the business, for that investment firm has to earn that. So when firm is going to earning the return towards the invested amount, so that is nothing but cost of capital. Let us move to the definition. According to the Hampton, he is going to define, see, cost of capital is a rate of return the firm requires from investment in order to increase the value of a firm in the market. So according to the cost of capital means what? A very simple manner, he is going to define that cost of capital is a rate of return, and whatever we are invested investment in money in the business, for that increasing the return, when we are going to increasing the return, proportionately the value of the firm will be also increase in the business. Second, according to the Solomon, the cost of capital is the minimum required rate of earnings or cut-off rate of capital expenditure. See, both the authors, they are going to defining. Solomon is going to define it is a rate of return. Sorry, Hampton is going to defining the rate of return, and Solomon is going to define it is a minimum required rate of earnings. Means return nothing but earnings. Earnings is nothing but what? Returns. They are going to defining in a different methods. We'll move to the next. That is a basic concept. Just you have to read out it. You will be understood. And next is very important, the classifications of cost of capital, nothing but types of cost capital. This is very important for 2 marks related. So basically the cost of capitals are divided into marginal costing and average cost, and explicit and implicit cost, future cost and historical cost, specific cost, inclusive of combined cost, and spot cost or normal cost. Let us start one by one. Marginal cost. Very simple manner, marginal cost is the additional cost of manufacturing. Okay, and what is average cost? See, average cost is a combined cost of various sources of capital such as debenture, preference shares and equity shares. Is it clear? What is marginal cost? A marginal cost is an additional cost of manufacturing an additional unit. For the additional unit, additional cost what we are going to incurring, that is what a marginal cost. An average cost is a combined cost of various sources. Means whatever we have a different sources, for all the different sources, the source will be total. That is what combined average cost. Next, explicit cost and implicit cost. This is most important among all. Explicit cost arise when funds are raised. When you are going to raising the fund, when you are going to collecting the fund, at the time explicit costs are incurred, and implicit costs are incurred at the time of when you are going to using the fund. So that is what the implicit cost. More again, when we are going to talk about more regarding explicit, already I told you explicit costs are raised at the time of fund collecting or fund raising. For example, collecting of preference shares, equity shares, debentures. Is it right or not? At the time, generally some amount of expenses or some amount of charges are going to we have to be paid or we have to be incurred. So those are explicit cost. So implicit cost means when you are going to using the fund, at the time basically these will be arise. Next, future cost and historical cost. See, future cost is nothing but estimated cost. What will be happening in the next? So that is future cost. So what that is what a estimated cost. Historical cost is nothing but what a book value. So what we are going to record in the books, so that is what a historical cost. So let's discuss future cost. It is refers to the cost of fund intended to finance the expected project. It means in the project whatever we are invested, for that fund we are going to expecting, that is what future cost. All financial decision making, expected rate of return and expected cost of capital are considered. Future costs are widely used in capital budgeting and capital structure designing and decisions. According to this, in simple manner I will be clarify this concept. Future cost will be is expected rate of return and expected cost of capital. Expected rate of return, expected rate of capital, that is what a future cost. And basically future cost is to be used in widely capital budgeting as well as capital structuring, designing as well as decision making. Next, historical cost. See, it is a cost which has already been incurred for financing a particular project. Historical costs are used in analyzing the existing capital structure in projecting the future cost and providing an appraisal of the post performance when compared with standard or predetermined cost. So historical costs are the base of existing capital structure. Very simple. See, historical cost is nothing but a book value. It is a cost which has already been incurred for the financing a particular project. See, historical cost is a cost. This is a cost already appearing, already happening in the project. So that cost we are going to recording. That is what a historical cost. It means is incurred for the financial particular project. Next, fourth one, specific and combined. See, specific nothing but a composite. Combined is nothing but what a weightage average cost. So these are the different meaning. So specific is nothing but a composite, and it is a component of capital structure. Example: debenture, preference shares, equity shares, etc. It is a implies the cost of specific sources of fund is nothing but, see, specific cost is nothing but a composite. It's a mix combination. Okay, composite. So what will be include in the specific cost? It is a component. It is a component means what? It have a different pillars. It have a different component. Component itself means debenture, preference shares, okay, equity shares, etc. So when these all will be included, that is a component of capital structure, is nothing but a cost of, sorry, specific cost. And what is combined cost or composite cost? It is aggregate of cost of capital from all the sources of fund. So it means aggregate. We have to make it a total. When you are going to making a total, that is combined cost. That as what it will be, for what we are going to make it the aggregate of all debt, equity, preferential capital and other loans. That total will be what? Aggregate. The aggregate is to be what? Combined or composite cost. We will move to next, fifth one, last one, types of cost of capital: spot or normalized. See, spot means what? Spot costs are those costs prevailing in the market at the certain times. It means these costs are incurred before entering into the market. Such cost will be incurred. That is what a spot cost. Next, normalized cost. So these are long-term cost. It is an estimate of cost by some averaging process for which the cyclically elements in removed. These are normally used for taking overall investment decision. See, normal cost are the long-term cost, and these are estimated of the cost of some averaging based on what? Cyclic. So these are the different types of cost of capital. The among that is most important, marginal costing and explicit and implicit costs are very important. But you should be prepared all, you should be studied all the five types of the types of cost of capital. This is only theoretical concept. There is no connection between the problematic aspect, but you should be understood. Connection itself means what? When you are going to taking decision, exactly the types or classifications of cost of capital is very important. But when you are going to solving the problems, most important is a formula, because we are going to solving debenture, preference shares, equities related problems. At the time, formula is very important. Okay. So in the next class, we are going to discuss different types of uh, cost of capital. For example, debenture, equity shares, preference shares. Related to that, we have to be discussed. Thank you.